The sell side is exactly what you said, which is some lack of liquidity for the existing investors through traditional paths like an IPO mean that they're forced to look more at the secondary market as a potential option for liquidity. And so we certainly see more of the kind of like early stage investors, people whose funds are reaching like that maybe 10 to 15 year milestone, really having to and wanting to turn to the secondary market to get liquidity.
Welcome to our webinar on secondaries. This one, I'm Alicia with Seraph and the Seraph Compass by extension. Just to do, I think I'll do a quick background and then we'll go ahead and get started because this is not at all about me. With the Seraph Compass, we try to do weekly education in the written form. So we have a blog that goes out that most of the people here are probably familiar with and subscribers to. And we're starting to do monthly education via webinars on various topics. A lot of the topics that we are talking about, trying to learn about, are my own curiosity project, is what I like to say, because there's a lot of things that I just don't know. And so our software is meant to help people manage their portfolios, but you can only invest in things that are going to return a solid portfolio if you understand what you're investing in. So that's what the Seraph Compass is supposed to be, is an educational hub for venture investments, private investments. But we have Sean Jones with us here today. This webinar is a collaboration with Hive, because Seraph knows nothing about secondaries and Hive knows everything about secondaries. And so you guys probably have heard of Hive. I heard about you guys probably 2 years ago. You first came on the radar, and I think that was somebody just sent me the website because they were like, hey, this brand looks really cool, because you guys have done a phenomenal job with design and branding and marketing. And that's just a side note that I think it's done really well. You guys are a marketplace for private stock, and I see now you're branded as pre-IPO private stock. I don't know if it started there, but that's what it looks like now. Sean, I think let's have you give your background first and how you got to Hive. And I know you spent some time at Barclays in London, and I don't know if you're English because we haven't talked before, but I would love to hear your background, how you got into this, and then give us a background on Hive and what you're doing, what you're building.
Brilliant. Yeah, no, thanks so much for having me on. I really appreciate it. It's great that you guys are reaching out and looking at the space and really keen on getting that education piece in, which I think is really important because this space is very new to people. It's very different. Private investing doesn't work in the same way as public investing for many obvious reasons. So thanks for having me on. I can't claim to know everything about secondaries, but I do know a bit about secondaries, and I'm very happy to share what I do know. So yeah, again, I'm Sean. I've been at Hive for about 3 years now, so that ties in with when you started hearing about us. I am the token Brit here. That you can't get away from us. And really, so in terms of background, I spent just over 10 years at Barclays Investment Bank in London, always on the public side of the markets. I was responsible for covering global institutional investors in the fixed income space, so G7, government bonds, interest rate derivatives, that sort of thing. So very deep liquid public markets. And so I then went completely over the other end of the spectrum into a bit of the wild west of the private markets. Found Hive about 3 years ago. When I initially joined, we were about 30 people at the company very early on in our growth phase, and now we're about 150. When I started here, I came in to help cover institutional investors. And as we've grown, I've also grown with the company, and now I help run our sales and trading division, which is, I want to say, about 30 people now, just in that division alone. So definitely a lot of change there. I spend about half my time helping manage the team and run kind of that side of the business, and spend a lot of time working with our product teams, just working on the tech side of the business, because that's a key piece of who Hive are. Also helping just really to scale and operationalize the business to take advantage of the opportunity that's in front of us. In terms of Hive, we are, as you said, a marketplace for trading shares in private companies. What is the sector that we operate in? I would say it's, generally speaking, kind of $500 million plus last round valuation and VC-backed companies specifically that we focus on. So call it that Series B and onwards, mid to late stage growth companies. I'm very happy to delve into like why we're focusing there if you want a bit later. But that's the place we operate in. And we are one of, if not the biggest player in this space globally as it stands. Last year, we did bit over $1 billion of transaction volume through the platform. And this year, we've exceeded that $1 billion mark already this year. Things are looking up for us as it stands. What does Hive do? What's our kind of USP? Well, this space, as I'm sure you're aware, has historically been very opaque, very illiquid, lack of transparency, all the usual things that you'd expect with a kind of immature market structure. And Hive is trying to bring some efficiency, some standardization, a lot more transparency, into that space and really bring a technology aspect to it as well. So the world of picking up the phone and needing to, by appointment only, dealing with a broker over the phone or through the email is something that we're trying to disrupt a little bit. We definitely do have salespeople who help facilitate transactions, but at the same time, we've tried to build a product that allows people to self-serve and really enter the stages of a secondary transaction without necessarily needing to speak to a human. Not everyone wants to speak to me, unfortunately, but that's where we are at the moment. And so that's me, and that's a bit about Hive.
Amazing. And congratulations on all the growth and success. I know that that's huge as a company that's 4 years old. That's you guys are that's fantastic. Over $1 billion in transactions. That's yeah, a huge milestone. So I hope you guys had a modest pizza party, ping pong
Thank you very
party,
much.
whatever startups do. Yeah. No, that's fantastic. So I want to start from the very like beginning in terms of base level education on what secondaries, because
Mhm.
the reason I really knew that this is something to talk about was it was an in-person like speaker panel a couple months ago here in Florida, and all three of the VCs on the panel, I asked them about secondaries, and they said that we 100% now have a full-blown secondary strategy as far as getting liquidity for the fund. And that's also, one of them cited that secondary transactions were like over 50% of the liquidity that VC funds saw in, it was like Q1 of 2020. I think it was 2025. I think it was this year. Maybe it was last year, so I didn't get my stat right. But they're a big thing. They're growing. People are interested in them. So can you start us from like the ground level? What is a secondaries transaction? And then we'll go from there.
Yeah, absolutely. And forgive me if some of this is a little bit high level. At its most basic, primary is issuing shares and secondary is trading of existing shares. Taking back to basics, how do companies raise capital? How do they access capital markets? They typically go either through the route of debt, bond issuance, loans, or equity, so the equity route. And it's very common for private companies to tap the equity markets for funding. So these are what you would consider to be a funding round for the company. So as part of those funding rounds, the company itself will issue new shares, and investors will purchase those shares by investing in the company, and the capital that they're investing goes directly to the issuer, which is the company itself. So that's what we call a primary issuance, and that's what we would call a primary transaction or a primary funding round. Now, once those shares have been issued and are in existence, if they then were to go on to be traded after, that would be a secondary transaction. So it is the transferring and the trading of existing shares. And in those transactions, it's the owner of the shares that receives the money and the proceeds from the transaction, which may well be the company if they own those shares themselves, but it's not injecting capital directly into the company. So secondary trading is just trading of existing shares. And I think that there's kind of two worlds here when you think about secondaries, especially in the kind of the venture and the private space. One is fund secondaries, which are typically big funds that hold shares of 100 different companies because that's the investment mandate. And then the thing that we're in is single asset secondaries, so specific company, the trading of specific company shares. And that's the space that's been really seeing a lot of growth over the last few years itself. So hopefully that answers the question clearly.
No, that's fantastic. And I always like to start from the bottom and build up into things that are more complex, but I want everybody to just get like a base level, what we're talking about here and what we're not talking about. And so that's very helpful. Can you describe to us the players, the people that are involved in the transactions? Because broadly it's the company, right? That you've got shares in. So we're talking about investors, we're talking about founders, we're talking about people that want to buy into the company, but can you like landscape that for us a little bit, people involved in the transactions?
Yeah, absolutely. I like to split these things into individuals and institutions because they're kind of like different profiles of buyers and sellers. So on the institutional side, it's really the players that you would expect to see in this space. Venture capital funds, as particularly growth equity funds, are the big players here, and the asset managers are the big players on the institutional side. Now, as the market has grown and the kind of number of participants has increased, we're starting to see, and we have seen new entrants or just an increase in activity from the likes of hedge funds, crossover funds, so funds that invest in both public and private markets, even pension funds and sovereign wealth funds, and then certainly seeing more and more interest from family offices and the wealth channel as well on the institutional side. The sellers on the institutional side would be those early stage investors who are looking to return some capital back into the fund. On the individual side, sorry, the buy side of the individuals is going to be certainly accredited investors, so high net worth individuals and ultra high net worth individuals that are looking to participate themselves. There's obviously, this is extremely risky market to be a part of. And so we do have, especially in the US, we have these accreditation requirements that people need to meet. On the sell side of the, and so those are your angel investors, right? And then on the sell side of the individual transactions, again, it may well be founders who have equity in the company, and we do sometimes see a founder maybe looking for some liquidity because they're starting a new company and they need capital to inject into that new endeavor. But the sellers are typically employees or former employees of the company who received either options or stock as part of their employment. And so these folks can have a significant portion of their net worth locked up, if you like, in the shares that they've earned through their employment. And so the beauty of the secondary market is that it allows people to take some chips off the table, to get some liquidity. And then some of the really cool stories that we start to see here at Hive involve people who have sold the shares, some of the shares that they earned through their employment, and they're putting their kids through college, they're paying medical bills, they're buying their first house or their dream home. And so we do get to see some pretty cool stories like that as well.
Yeah, and that reminds me of a joke I heard very early on where they've got a net worth like on paper of $10 million, $20 million, like some sense in the bank account. And so I think from a motivation standpoint, that makes sense for the founders. What do you think? And I probably didn't prep you for this question, but what do you think the perspective is as far as founders taking chips off the table? Like when founders want liquidity, how are investors responding to that I suppose the early stage ones maybe don't care as much but like, what's your perspective on how investors view the founder thing?
Yeah, great. That's a great question, and it would be very easy to see that as a signal of a lack of confidence in a company, right? And so that's obviously
Mm.
something that founders or certainly execs need to navigate as they go through this process. But I think that it's definitely case by case. We people are understanding, right? I think exactly the situation that you explained is people have, especially very successful founders, can have huge amounts of their net worth locked up in shares. And so we generally take the view that selling everything is probably a negative signal, but selling some of your holding is actually very healthy because we've actually did some surveys that we can probably send out afterwards, which show how allowing employees, and maybe founders are a bit of an exception to this one, but allowing employees to sell some of their shares is a huge retention tool. And it's actually a thing that can be very attractive when you start looking to hire top talent is, hey, look, we recognize that we're going to give you shares as part of this story. And if the company grows the way we expect it to, you're going to have huge upside, but we don't want you to have to wait for a liquidity event that we'll probably talk about in a bit. We will allow some periodic selling of shares, and that can be a huge retention tool. I think it's a very healthy, positive signal for a company to be open to these things and for people to understand that people don't necessarily sell shares because they don't believe in a company anymore. That's a bit of a false narrative, I think.
Yeah, that's fantastic. And I think coming from the founder side, so before I was with Seraph, I was the COO of a very high growth company and then a couple other ones. And when you're putting together a comp package, offering stock is all like fine, but then a lot of times that's disregarded. It's not regarded as something like true
Yes.
or material. And if you had a narrative where like in a couple of years, this has a legitimate path to being cash, right? Because people care about cash. That's really cool. Thank you. So I want to get into deal structures a little bit, but first I think understanding, I think the discussion around secondaries has increased quite a bit. I don't know what you would call it because you're deeper in it, but for me, it seems like the last 12 months or so.
Yeah.
And from my view, that coincided with a lot of non-exits in Q1 and Q2, and then some level of the I don't know if it's a bubble, I think it's a bubble, but propping up of what we have here in investments. What have you seen in terms of the market? So secondaries are becoming more generally accepted. Their transaction volumes going up. Why do you think that is? And can you talk a little bit about that?
Yeah, absolutely. And to be honest, I think you've already answered the question. So the two things that really stand out to me at the moment are one, this kind of structural situation in the market whereby private companies are staying private for longer. And in that, I would just throw out a few of the big household names. If you think about SpaceX, if you think about Stripe, if you think about ByteDance, if you think about OpenAI, for example, which owns ChatGPT, there's hundreds of billions of dollars worth of value in those companies alone. And from what we can tell, structurally, they are in no rush to IPO or to have a sort of meaningful exit. Certainly, I think Stripe have spoken somewhat publicly about the fact that they don't necessarily feel the need to have that exit, that IPO, in the way that maybe once people did. And so that means that companies are staying private for longer. And those companies, a lot of the value creation is happening while the company itself is still private. And so
Mm.
what's quite natural in that sense is if you really want to capture as much of the upside as you can, depending on your attitude to risk, of course, people will start naturally gravitating away from public and into private in some sense, because if you want to capture some of that potential upside in the company as it grows and creates value, you will naturally need to focus more on the private markets. And so that's the buy side of that situation. The sell side is exactly what you said, which is some lack of liquidity for the existing investors through traditional paths like an IPO mean that they're forced to look more at the secondary market as a potential option for liquidity. And so we certainly see more of the kind of like early stage investors, people whose funds are reaching like that maybe 10 to 15-year milestone, really having to and wanting to turn to the secondary market to get liquidity. That's the first piece, which is structural. The second piece, again, is exactly what you touched on. I think it's a sectoral thing. And what are the most popular sectors right now in the market? Certainly, we see a ton of interest in the AI sector. And of course, the Googles, the Microsofts of this world, the Metas, they're all in the AI space as well. So there's the publics there. But if you think about the actual true AI companies, many of them are quite early stage and many of them are still private, but very big. And so if you
Yeah.
think about Anthropic, if you think about OpenAI again, which is the ChatGPT, Perplexity, there's a whole raft of these names. Glean, like I could just rattle off 10, 20 names very easily. So people want to get involved in the AI space, and that is predominantly private at the moment. So that is really certainly making people look to this space a little bit more. Crypto is also, Web3 is quite popular at the moment, and same with robotics. And again, a lot of those companies tend to be in the private space as well. So sector and structural, I think, are the two things that have really driven the interest in this space.
Okay, thank you. And when these transactions, not to talk a little bit about the actual transactions themselves, and I see we
Mhm.
do have a question. You guys can drop questions in the Q&A as we go along. We'll probably wait till the end to answer most of them. Sorry, I should have said that in the beginning for housekeeping. But as far as the transactions go, what is the typical structure that you are seeing? And I'm curious what percentage of the total company stock is typically being sold in a transaction. If that just varies deal by deal. Or could you describe a typical transaction for us? If they're one, it doesn't have to be specifics, obviously, but just a general idea.
Yeah, for sure. The most typical transaction structure is what we would call a direct transaction. It's really what Hive was originally built to facilitate. And a direct transaction is where you have a seller of shares, you have a buyer of shares. They agree to terms to transact. On Hive, that would be a match. And so when they agree to transact, the resulting, if the transaction then goes ahead, is the shares are transferred, the legal ownership of the shares is transferred from the seller to the buyer. So it's a direct transfer of ownership from the seller to the buyer. Now, the way that actually works in practice is once the buyer and seller agree to terms on a transaction, in many cases, the company itself also has to approve that transaction. And that's a very key distinction between the public markets and the private markets. So what will happen is, let's say you agree to transact in a direct transaction through Hive. We have a whole team of people at our execution services team who then take that transaction and they submit it to the company and request their approval. So you go through their approval process for the whole thing. And I would say that applies to most transactions. And our relationship with the company in that case is very important. We have to have very strong relationships with them to understand what their process looks like. But you have to go through this approval process. In most cases, once the transaction then goes through that, assuming it gets approved, we then go through to the closing process, which is the wiring of funds, the actual transfer of legal ownership from the seller to the buyer. And I would say, again, that's the most typical way people transact, and usually the one that people would want most of the time. The institutional market, the large check sizes, the big institutional transactions still very much work in that way. These are your kind of like anywhere from five all the way to $100 million plus transactions happen in that way. And in terms of sizes, Hive's minimum transaction size is 25,000 US. So we really run the gambit from that kind of what probably to you and I is a very big amount of money, but to this market, that's the small end, and then we go all the way up to 100 million plus in size. The structure that we're seeing more recently, I'd say in the last year or so, year or two, is in funds, so single asset funds. You might have heard these referred to as SPVs, special purpose vehicles. Obviously, those have been around for a very long time. That's a very traditional way of structuring certain transactions. That has definitely taken off, I'd say, in the last year or so. In fact, Hive now offers its own single asset funds. We call them Hive funds. And the way these work is they're really a tool for one of the big things they help with is access, right? Everyone wants access to be able to invest in companies and buy shares of companies, but often that access is hard to get. And there can be size mismatches, is a classic example. We may have an institutional seller of shares that's looking to sell $10 million worth of a single of stock, and they're not interested in doing that in 25, 50K tranches. They just want one single transaction and that's it. So what we can do is we can aggregate demand across a number of investors who are interested in that, getting exposure to that company, bundle all that demand up, place all of that into, purchase the shares, place them into this legal entity, which is the Hive fund. And then all those investors can invest in the vehicle, which itself owns the underlying shares or will own the exposure to the underlying shares. That's really been a very big growth piece for us and certainly for the market. So I'm sure you've heard a lot about SPVs, and there's been a lot
Yeah.
of press about them as well. And a lot of it also comes back to, we were talking about company approval for transactions. So sometimes companies are very restrictive on who they will let purchase their shares directly. And you may well find that access is only possible through one of these SPVs that holds the underlying shares themselves.
I love everything about that. That is so cool because I didn't know that you guys had that component that it's your syndicating checks into secondaries. That's so cool.
Yep.
Yeah, no, I love the principle in itself and why it exists for angel groups, but now that on this level, that's fantastic.
Yeah.
And you guys have for those indications, your minimum barrier for like accreditation still exists as well?
Yes.
Okay.
Yeah. Yeah. The way they're legally structured, the vehicles, they're Delaware entities, and so it is still an accreditation requirement for those.
Okay. Yeah, that makes sense. That's what I thought. I just wanted to make sure that I have seen some, I don't know, maybe it's just Twitter rabbit hole conversations about blockchain and how we get like the everyday investor to invest prep startups. And I was just curious if
Yep.
that was.
Yeah, that's a really interesting space. You've heard, I'm sure, about the likes of Robinhood tokenizing investment
Yeah.
opportunities. Our focus is very much on the kind of wholesale market. So we're not in that sort of that element of the, what I say, being inventive, but it's definitely a very interesting prospect. And yeah, I could talk about it for days, but yeah, it's very interesting. We're not in that space at the moment.
Okay. Okay. Wonderful. Next question for you. I want to talk about pricing in the transaction. So that given this is all private market stuff, how do you guys go about pricing? So I guess the first question, are you guys determining pricing? Is it the company? Are you like advising on that? And how does your pricing process work? Because this is all murky at best.
Yeah, I wish I had an answer. Okay, so the headline is that for a secondary transaction, these transactions only happen if a buyer and a seller agree to terms. And so it's very much in the ballpark of those two parties to agree to a price, right? The seller can set the price at which they're looking to sell, the buyer can set the price at which they're looking to buy, and somehow they may have to negotiate with each other to arrive at a price. So in that respect, it's different to primary funding rounds where the price is set. This is the valuation and the price at which you're investing. So that's one key part of secondaries. It's much more a free market trading situation that is a lot determined simply by supply and demand in a lot of
Mhm.
cases. In terms of actually coming up with your own valuations, you'll hear me say this once and probably again, not financial advice. I'm not able to do that. But what people generally, so first thing you would obviously want is financials, right? Company performance metrics and all that sort of thing. By the very definition of private markets, that is very hard to come by for the average Joe, for you and me. But some companies do release some information publicly. And so there may be some numbers on revenue and stuff like that you can find through public sources. I know, for example, Kraken is one of the most heavily traded companies on Hive. They actually publish their financials and make them public. So that's like a bit of an industry leader in that respect. But clearly, ideally, you would get financial information, build a valuation model, and then look at maybe public comps to get yourself to a valuation at which seems interesting. Again, that's very hard to come by. So what else do people look at? People will look at what's called the 409A valuation, or the fair market value. That's an internal valuation that is done by the company itself. We can talk about the pros and cons of that, but that is a metric that people look at. I don't think it's hugely informative, but it's a data point. The other thing people look at is the valuation and the price that occurred for the most recent funding round that company did. So if
Okay.
you think about what was the most recent round this company raised capital at, if that was, say, that was a month ago and that was their Series D, that was a 50 billion valuation at $29 a share. Often that information can be found through public sources, and that gives you a very clear data point, right? That is the price and valuation at which institutional investors usually wrote checks and invested in the company. So that gives you a very clear data point at which people were prepared to put their money into a company. And then you just have to account for the fact that there are varying things that would make the price change in the time difference between that. The value of that information decays over time because the market's going to move. There's some structural things about the share class and stuff like that. But most recent funding round, very helpful piece of information that people often look for. And then, of course, the other thing is just where is the secondary market trading for the company, for the shares that I'm interested in? And that's the place where companies like Hive really are trying to step in and shed some light on that piece of on that space, which is we publicize the platform. We have a price chart. It's called our Hive price. It basically takes into account the price that people have listed shares for sale, the price that people have bid or placed a buy interest, and the price at which actual transactions have happened to create this kind of an aggregate price, if you like, a weighted price that gives you insight into where transactions have been happening or where interest has been in the secondary market that allows people to anchor a little bit to that.
Okay, that's interesting. And the companies, so if they're listing stock for sale, do they match on a price? Like, so buyer and seller match on a price, and then that price and that specific transaction gets approved by the company. And how much risk is there in that, like in that little gap? If that is the process, where I'm a founder, I just want $100,000 for my $1 million shares so I can buy a house or something. Like,
Yeah,
how does that work?
that's exactly the process. So I'll just use Hive as the example, but again, that's my easiest thing to use as an example, but we're not the only place you can do this. I'm not here to talk too much about Hive, but you basically anyone who holds shares in the company goes onto the platform. They create a listing, so that is them saying this is the number of shares and the price at which I'm looking to sell them for, and then that is anonymous but visible on the kind of order book on our page. Now, a buyer can go on and place a bid on that listing, which is them showing the price at which they would buy the shares. Now, those two things might be different, right? And so there can be a little bit of negotiating between the two. Eventually, they arrive at a price at which the seller is comfortable selling and the buyer is comfortable buying. They know the number of shares and the price. That gets agreed to. And so very much those two parties are in control of the pricing part of that. We now have an agreement in principle for these two parties to transact. We then take that to the company and we say, hey, we now have a proposed transaction. Here's the buyer, here's the seller, this is the number of shares, and this is the price they're looking to transact at. Please let us know. Please initiate your approval process and let us know if you need anything else from us. Now, the one added layer of complexity into this, and I'm not sure if you've gone through this, but it's called the right of first refusal. This, you'll colloquially hear it, the ROFR, ROFR. And what that is, in many cases, especially for common stock, the company itself has the right to purchase those shares at the agreed terms in place of the existing buyer. And so basically what happens when we submit the trade to the company, they take a look at it, they decide whether they're going to approve it, and B, whether they are themselves going to purchase the shares or one of their investors is going to purchase the shares in place of the buyer. And typically that process can take up to 30 days. So once you've agreed to the trade, it then is out of your hands for a little bit while the company decides what it wants to do. If they decide to step in and purchase the shares in place of the buyer, then the seller is happy because they still sell their shares, but unfortunately the buyer is no longer a party to the transaction, and then it goes through to the closing process. If they just approve it, it'll just continue as proposed and go through to the closing process, and then we handle a lot of that. And I think this kind of touches on one of the questions that you had spoken to me about before, which is what are some of the risks in getting involved, or like things to be aware of when getting involved in this space. And certainly for investors, that is one of the things. Buyers, I would say, one of the things to be aware of is this, we call it ROFR risk. It's just the chance that the company buys the shares instead of you, or that the company blocks the transaction if they deem that the right thing to do.
Do these transactions trigger I think my brain says most favored nation clause, where like when you raise an investment round, you basically agree that all of your Series Seed investors, or maybe it's specific to that round, where the terms that they write in, nobody else can buy outside of those terms. So whoever gets the best terms on the term sheet, everybody has to conform to that that
Mhm.
level, but maybe that's just specific to the transaction. Because I was just curious if there, so the company could theoretically block it, the company could buy those shares rather than the buyer. Is there any other transaction blockers to be aware of?
I'd say those are the main ones. I think the clause you're referring to is not something I'm overly familiar with, so I feel like it's
Okay.
probably linked
It might be
specifically
my
to
brain just.
primary funding. Yeah, exactly. Those are the main ones, I would say.
Okay, fantastic. And what other things should people look out for? So moving to the next question, red flags that you see pop up both on the investor and the seller side, or
Mhm.
anything that would be useful if somebody was just trying to peek under the hood and see what should I look for if I wanted to try to do my first secondaries transaction or buy into my first secondaries transaction? What would you look for?
Yeah, look, pricing is always going to be something that's going to be challenging for people to know. One thing that's always worth being aware of is asymmetry of information. Someone on one side of the transaction may know more about something than someone else on the other side of the transaction. So really trying to get as much information and do as much homework as you can on the price at which things make sense, I think is a kind of like something that's definitely worth bearing in mind. That for the transactions, like we discussed already, direct transactions, it's definitely worth being aware of. These things take time to go through. It's not you click a finger, you agree, and it's done. It really can take anything from 3 to 8 weeks, really, for a transaction to go from we've agreed to terms to actually closing. And there is that transaction, that risk of the company kind of blocking or roofering as you go through that. The second thing that I think is really important to be aware of is in this SPV space, in the single asset fund space right now, you're not just investing and buying shares in the company directly yourself. You are investing indirectly through an investment vehicle, through a legal entity, right? And so in those cases, people really need to go away and do their due diligence on the investment itself. So not only do you need to understand the company that you're trying to invest in or that you're trying to get exposure to, but there is counterparty risk here, right? That you are investing in an investment vehicle. So who is the manager of that vehicle? Who's the GP? What are the terms of the investment? What does the fee structure look like? Because now we're starting to go into the funds universe, as you're well versed in. And so we're thinking about what are the fees? What is the structure? Would I be able to sell in the future if I want to sell my holding, my units in this fund? Even a simple question is, do they own the assets that they say they own? That's just part of general due diligence. And so I think that at the moment where everyone really wants to get access and is clamoring to get access to some of these really popular companies, it's really important to just sometimes take a step back and think, what is it that I'm investing in? Do I need to understand not just the company itself, but the counterparty that I'm dealing with? And certainly you should be questioning Hive or whoever you're transacting through, right? Are these people who they say they are? This is definitely a very young space. It's very, very early. Obviously, like we're regulated by the SEC and FINRA. You definitely want to be aware of all these different things. And there's a lot of players in this trying to get into this market as well.
Thank you. Thank you. That's helpful, I think. And they've got you guys have a very reputable Englishman on the team, and I'm sure you guys have no problems with branding. Another question for you? So a lot of and I asked this question because this recording will likely go out to a lot of the audience here, and a lot of the audience, as far as the Seraph Compass goes, are angel investors, very early stage, and also early stage VCs. So we have some customers and audience that spans into Series A, but a lot of them are at like seed, pre-seed. If they end up in a scenario where they have equity in a company that is doing well, so they invested at pre-seed, they got in early, they're lucky enough to be a part of that pool. What would you recommend for like angel groups who have they syndicated an SPV at pre-seed or seed, and now it looks like they want to not necessarily sell with a Series A or a Series B, but they want to do it in a secondaries transaction? What would you recommend for a scenario like that? Because I imagine with our audience, that's close to what people might be seeing, and we'll go into questions pretty soon after this, but that's one that's on my mind because I'm curious.
Yeah, for sure. And we love speaking to angel investors that invested early stage in companies because those people they're really interesting people to actually talk to, but also I think that those people can be sitting on large paper gains that they may be ready to take some chips off the table and maybe reinvest back into other early stage companies because that's the sector that they prefer to be in, right? And so we love dealing with people like that. I love hearing those stories. At the end of the day, like we again, let me try not to just make it too much about Hive, but we help facilitate transactions, right? And the easiest transaction for us to help facilitate is usually a direct transaction. If the shares are held in an SPV, then if we have a buyer who's interested at those terms, or if you are able to find a buyer that's interested in at those terms, then you would be technically transferring your LP stake or your units in that fund to that potential buyer, right? And so in that case, the two things you need to think of is number one, would I be selling my holding of the SPV, or would I be able to sell the shares that are in the SPV out of the SPV and directly to the person that's looking to buy them? If you're basically trying to sell the units or the holding in the SPV itself, firstly, people will be interested in understanding the terms of that, the actual structure itself. So does it have management fees? Does it have carried interest? In the mid to late stage space, I would say people are more interested in 0-0 structure, so no management fees, no carried interest. It's much easier and cleaner to think about that conceptually from a valuation perspective. So if there are fees and carry, then that's just something that we have to bear in mind. That kind of, in some ways, narrows the scope of potential buyers that are out there. And then the other thing is, do you actually have the right or the approval to sell your holding in that, your ownership of that SPV? So then you need to go through to the manager, speak to them like, hey, look, I'm potentially interested in selling this. Would you be open to that? What are my options here in terms of liquidity? Just because the SPV has been created by someone not anywhere near Hive doesn't mean that we can't help facilitate those transactions. But these are things that are worth considering as you go through this process of investing. As definitely at the angel stages, it's very common, as I understand it anyway, for there to be these structures with fees and carry. That's how the GPs make money, right? That they're not doing this for free. But that can impact the ability to resell in the future, just in terms of the structure and the overall sort of situation there. Does that kind of help address some of that?
It does. No, it certainly does. And I've got my ear to the angels and to the early stage VCs, and a lot of the frustration is that they don't have, IPOs are slow and the acquisitions are slow, and therefore there's no liquidity. And then people it's like a 8 to 10 year portfolio, and they're like at the edge of their, like, is this asset class making sense for us type of conversations. And so I just figured I'd bring it up because it's always good to know your options, I think. And now I have taken up far too much space on asking questions. I'm going to ask one more, and then we're going to go to the Q&A because I also want to get this one in. But you guys can drop questions. So we've got some in there already, and continue to drop them if you have them. And so last question for you, at least from me. How do you see the market evolving over the next 3 to 5 years? What are you guys planning for? I know you have a launch coming up, but I don't know what the launch is, so you can announce that later. I'll watch for social media drop. But what do you see happening in the market the next 3 to 5 years? What are you excited about?
That's a great question. So I do think that the interest in this space is going to continue to grow. I do think that companies will probably structurally stay private for longer. There is going to be a continued value creation happening in this space. Of course, as the market gets more buoyant, more positive, it's natural for companies to have exits and IPOs. So I don't think that's going away anytime soon. But I think that if you're able to create something of a liquid market for your stock as a private company, which is where we think we're coming into play, it helps relieve some of the pressure on the company itself to IPO purely for the reason of allowing people to have an exit, right? If you allow your shareholders and your employees to gain some liquidity through the secondary market by establishing a market for your shares, it takes some of that pressure off. And I think that, we really think that we can step in and provide that as a service, help a company establish a market for its shares, leverage the technology and the network that we have, work with the company to establish their parameters. They can have their own rules for trading. They can have their own things the ways that they like things to happen. But if we can do that, it allows for the free trading of stock in a controlled manner, and it allows companies to stay private for longer. So I think there's a huge opportunity in that space to grow there. And then the other place that I think we're very focused is on relationships with the companies themselves. I'll say it again, this market is very young. In my opinion, it's very immature. The structure is just nowhere near what you have in established public markets. And the way in which companies deal with transactions is, it's like you send them an email, they get an email, they start working on their process. And these people they want to run a company. They're trying to build something great. They don't want to spend their time doing the administrative work of actually processing all these transactions. And that's actually a huge burden on those companies that takes away from their ability to do what they do best and what they're trying to do. And so I think that where we're trying to enter and take the lens here is being a very cooperative, very open to understanding those companies and working with them and bringing a huge amount of technology and standardization to that piece. It's not very sexy. It doesn't grab the headlines. but giving people the infrastructure to be able to process these things without needing to have huge legal teams and huge other teams, which is very costly and time consuming for them. I think we can
Yeah.
bring a lot of technology to that space. And as soon as you make it easier for them, that also helps unlock liquidity in this space. So I think that the technology, working with the companies, and then continuing to try and establish like free market trading, advocate for what we believe is something that makes sense, is where we think it's all going to go.
Okay, amazing. And I think from coming from the startup operator side, that makes a lot of sense to me, just in terms of how I would build a company and things that I would prep for, knowing what I know now. So I won't take up any more time on my own behalf. So let's go through questions because we've got a lot of good ones in here. 13 minutes left because I want to be cognizant of time. So I'm just going to go top to bottom because I think these are all wonderful. So Joseph says, can you discuss the legal aspects of the transfer of a non-public share to the extent that I know that's not necessarily your particular specialty, but anything worth mentioning there?
Yeah, definitely not my specialty. And I would say that there are a few things that are somewhat common in this, and then there's a lot of things that are non-standard. And it is typically, so one thing I would say is that in terms of like where the shares are owned or registered, we get a lot of questions on custody, which brokerage do I place these, do I put my shares in, or what have you. It doesn't really work like that. Companies typically use what's called a cap table management system, so either Carter or Morgan Stanley ShareWorks. That is where the shares themselves are legally registered and held. And so in terms of a structure, you have the share class itself, common, preferred, and then some of the key things that the clauses that'll be in there are around things like right of first refusal, company approval, some mention of how those things work and what the triggers are for all those different things. But they do vary. There's no one size fits all. And so as you go through that process, it's all about learning what that company specifically has in some of their shareholder agreements. It might be different for different people as well. So it's very much like trying to get into the weeds of that. And then when it comes to finalizing the transaction, the two parties sign what's called a share transfer agreement. That's the final kind of legally binding agreement that's signed between the seller and the buyer to finalize the transaction. And then it's the company itself that changes that or reaches out to the cap table management software Carter and then says, please, can you change the registered owner of these shares? So cancel that share certificate and create that new one for the new buyer. There's also a lot of sellers in the space that are employees who have options rather than shares. And so there's a whole nother legal framework that goes around option agreements. And on that side, all I would say with that is it is, again, case by case, but generally speaking, options themselves are not transferable. So sometimes we see employees having to exercise those options to end up having the underlying shares that can then be transferred as part of the transaction. Long-winded way of saying there's some commonality in the ROFR and right of approval, but it's very different in terms of the legal structure.
Okay, thank you. And that's very well done by a non-legal counsel. I think that answers the second question too from Mike about legal hurdles. Third question here, Samuel says, when buying an LP interest, how do you go about calculating the embedded and accrued fees that have accrued to date? Which is another hard in the weeds question.
Yeah, the good thing is I can answer that one easily because we don't go into that amount of detail. So if there are management fees and carry, the role of us, Hive, in this situation is very much as kind of like a matchmaker, right? People, in this case, you could go and list that holding that you have on the platform, and you can add some notes in there that would say there are management fees and carried interest associated with this. You can include some of the high level details. And it's what we try and do is get those high level terms out there. And then if we find someone who's interested in buying those units or the fund holding at those kind of like high level terms, what we'd then do is we would introduce the two parties to each other, because in this case, obviously the seller has very specific legal docs that govern the investment that they hold. And so the easiest thing we can do in this case is to facilitate an introduction between those two people so that the person selling their units can share that information with the buyer, and then they can go away and do their own calculations and come to terms with what the situation is. Otherwise, we would have to have a whole legal team that sits in the middle of this and looks through all of these things. Obviously, that's a huge amount of work and what have you on us. It also creates risk and liability for us if we start representing certain things about that specific investment that we weren't necessarily party to begin with. Long-winded way of saying we don't do those calculations. We help to try and match you with a buyer and then put you in touch directly so that you can agree to terms that way.
Okay, fantastic. And that answers the next two questions. So we're doing fantastic. Yeah, because Nick asked, do you guys play a role in finding and matching buyers, or are you simply a secondary transaction platform? So it seems like you do both at this point.
Yes, exactly. Yeah. So it's very easy to look at the platform and think, oh, look, it all just magically happens. Where did all these buyers come from? And so there is a lot of organic activity that happens on the platform. The technology does speak for itself in a lot of that. We have a fantastic marketing team who are like out there getting the brand out there, getting Hive's name out there and getting people to know more about us and sign up through that. But we also have this sales and trading unit, if you like, which is, like I said, 25 to 30 people who have an enormous network of contacts, especially on the institutional investor side. And when people show interest in something on the platform, whether that's buy interest or sell interest, if there's no clear organic match for those things, we are going out and we're talking to our network all the time to see whether those things could be of interest to them. And then if there is interest, we bring all of that onto the platform so that it's visible. But a lot of stuff happening behind the scenes to help things go smoothly.
Fantastic. Thank you. Next question. What is the typical cost of transacting through Hive? So I suppose your guys' revenue model, if as much as you can share.
Yeah, no, it's a great question. No, nothing to hide here. We take a transaction fee, and we only take a fee or get paid if the transaction actually closes. So there's no cost to signing up to the platform. There's no cost to getting on there. There's no cost to exploring, and there's no cost to even like preliminarily entering into a transaction. Only if that transaction closes would a fee be owed. For direct transactions, which, as I said, used to be like historically is our bread and butter, we don't charge fees to buyers in those transactions. We charge a fee to sellers. It's a scale that gets smaller as the transaction gets bigger, but very roughly you can think of it as around about, I think it's 4.9% down to low around 1% or lower on the sell side. The only transactions where we charge a transaction fee for buyers is into the Hive funds that I was talking about earlier. And that just reflects the additional complexity and the cost associated with us actually spinning up these legal vehicles and going through all the process of kind of operationally putting together the fund itself. They're also, as of like very recently, we now have an auditor. So those funds get independently audited every year. We want to set the standard in this space and really hold ourselves to a new level of standard and integrity. And so we're going to go through all these extra steps that have a lot of costs incurred with them. Most Hive funds are zero management fees. In fact, every Hive fund we've ever done is zero management fees, zero carried interest. So we make money on when people actually transact. And so that's why there's an investment fee, a buy side fee to buyers and investors in those funds. It typically ranges in the 2 to 5% range, depending on the size and the situation.
Thank you. And I appreciate the transparency. Last question here from Sonu. Hello, Sonu. Fantastic session, Felicia and Sean. So yes, great job, mostly Sean. Do you believe the secondary market can realistically provide the level of liquidity required for excess dry powder currently held by VC firms?
That's a great question. Look, there are both in this case, you're talking about the supply constraints really, because VC firms have a lot of dry powder, as I understand it anyway. I don't have that crystal ball, but depending on the size of the company, the secondary market can play a very big role. But it's definitely fair to say, like, some of the biggest transactions we've done have been $100 million plus in size. We don't do those every day, but they are obviously very large transactions. There are investors out there that would want $500 million if they could get it, right? So at some point, the supply side of the equation does become a constraining factor. And so as soon as you go into those larger check sizes, you're a bit more reliant on an institutional investor being on the sell side of that transaction as well. The other way that people can, taking away the mechanics of it, but like again, just going back to demand and supply, one really big source of supply in this market is through tender offers. So what you might see as a VC saying, I want to buy $50 million or $100 million more of this company. And at the same time, the company wants to offer liquidity to its shareholders. That can be done through an organized company tender, and that kind of helps fill both sides of that demand and supply equation. There are some companies that are out there doing that. Hive now is very much in the space of offering tenders to companies, and we see that as, again, another service that we can help provide. It helps provide liquidity to employees and to investors that want to add to their position. I would be surprised if you could fill all the demand in the world with the supply that is currently available in the secondary market, but I think we can get a good way to that. what we need is openness from the company itself to those secondary transactions, and kind of restriction lifting of some of the restrictions on transfers as well.
Wonderful. Thank you. Thank you so much. We've got 2 minutes, so I'm gonna cut us here. Are there any final thoughts you want to leave for the audience here at all? Any last things you would like to mention? Otherwise, we are
Yeah.
pretty close to on time.
No, thank you so much again for having me. It's been an absolute pleasure. I'm really pleased to have got to chat and to hopefully answer some questions that people have. If you're curious about this space, definitely encourage people to go away and do some reading. We're not the only people in this space, but I think we're some of the best. And go away and check out Hive. Go check it out, log in, see what it looks like. There's no obligation to do anything, but it's just an interesting way of getting to explore what we're doing and what's out there. And if I can help, or any of the team here can help, then please reach out. We'd be very happy to.
Wonderful. Thank you. All right, we will call it for the day. And everyone have a good day and a good weekend. Thank you.
Thanks a lot. Bye bye.